Whether you are interested in the FIRE community or you're just a regular schmegular investor looking to grow your investment portfolio, then sit tight and learn from one of the greatest investors of all time. John Bogle may have died 2 weeks ago, but his words of wisdom will forever lead our hearts when it comes to investing. In this video, I'll share with you 5 investment advice from the legend John Bogle. 1. Bet on long term. Yes, John was a strong believer of anchoring towards the long term when it came to investing, as he stated that the fundamental investment return, the dividend yield, always drives the long-term returns of the stocks market.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history. The reality is that the fundamental return, the dividend yield, plus the earnings growth of companies, drives the long-term return of the stock market. The only thing that gets in the way in the short term is the speculative return. Are people going to pay more for stocks? Are people going to pay less for $1 of earnings, in essence? Right. And if, for example, the price-earnings multiple were to go from 10 to 20, that over a decade, that would be a 100% increase. That'd be 7% added to the return each year. So it can be very substantial, and it also can be negative.
2. Go for higher percentage. Now, when you think about investments, generally when you want to start investing, you definitely always want to go with a company that can offer you the highest percentage yield. Actually, good news for you, John predicted up to a 5% return on index fund investment over the next decade. And obviously, you can only benefit from this type of investment if you invest in index funds.
Where are we now? Well, the dividend yield is about 1.8%, less than 2%. I'm looking for future earnings growth of around 5%. I don't think we can do much better than that. Maybe a lot better this year with the tax cut, and maybe a little bit better next year too. But maybe 5%. So let's call the dividend yield 2, and 5 is 7. By my numbers, that's the investment return. Right. 2% dividend yield, 5% earnings growth. That's a 7% return. And if the price-earnings ratio is to go down a little bit, I think 1.5% off that 7% return, which would be a 5.5% return on stocks over that period. And that's a little higher than I've been using. Maybe right, maybe wrong. I've usually been using about 4. But it's a ballpark. It doesn't really matter what we guess in these areas. There's no precision in any of this. Well, let's say in the 4 to 5% range, just for the fun of it, for stock.
3. Control what you can. There are lots of uncertainties in this world, and the last thing you need to do is panic over what you can control, especially with your finances. This is one of the things Mr. Bogle and other financial gurus have talked about for years and years on, meaning that in order to get the most out of the financial market, you should invest your money in index funds as opposed to picking individual stocks, since there is more stability in an indexed fund.
We can't do anything about inflation, but we can do something about fund cost, and that is keep them low, period. Right. Which means, as you're about to say, I'm sure, means index funds should be at the top of your list.
4. Avoid stock pickers. Now, if you're not familiar with who stock pickers are, they are also known as fund managers. According to Bogle, you should definitely stay far away from these guys as you possibly can. They do not have your best interest at heart and will not be able to outperform the market as they always claim to do.
I don't think there's such a thing as a stock picker's market, Tyler. All investors are picking all stocks. And to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of 1.
5. Beware of fees. Fees can definitely hurt your finances. Now, a lot of people are very happy to pay expensive fees to fund managers, especially when the market is doing pretty well and they're seeing growth in their investment. But also there's a downside to this, which means you still have to pay those expensive fees when your investments are doing badly in the market.
The fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency. The fees are too high, and that's all there is to that.
So there you go with 5 investment advice from this investment legend, and I hope it gave you some sort of comfort on what to expect from the market in the next couple of years, and also definitely what to know before you start setting up your investment portfolio. We will miss John immensely. His words of advice, wisdom, and everything he stood for in the financial markets will definitely be missed, and I hope you do some more research before you start investing your money. But before you go, don't forget to give this video a thumbs up, show us support by sharing and subscribing to this channel for more.